The oil crisis that could change the world overnight.
Right now, equity markets are hitting all-time highs, propelled by optimism around artificial intelligence, the most energy-hungry technology we have ever developed. It is a stark juxtaposition. We are betting on a massive digital expansion at the exact same moment the physical world faces its largest energy supply shock in history. Despite that physical disruption, the spot price of oil has remained relatively subdued, and the broader financial markets seem entirely unbothered. The catalyst for this shock sits here, at the Strait of Hormuz. This narrow maritime choke point is the gateway for virtually all Middle Eastern oil production, and it has been functionally closed. Before the closure, 20 million barrels of oil flowed through the strait every single day. Even after rerouting every possible barrel through alternative pipelines, the net loss to the global market stands at a hard 13 million barrels a day.
Is this just another cycle or the beginning of a bigger shift?
Yet investors are pricing oil based on political headlines. They are assuming a rapid geopolitical resolution, trading on the rhetoric of political leaders rather than volumetric data. But physical reality operates independently of market sentiment. The perceived stability you see on financial screens is being maintained entirely by the relentless depletion of finite commercial inventory buffers. To accurately read the state of this market, analysts have to look past the daily spot price. The true signal lies in the physical thermodynamics of the futures curve. Ignoring those physical mechanics in favor of geopolitical optimism guarantees a blind spot. If the physical math continues at its current rate, it guarantees an inevitable collision with a $200 barrel of oil. The global economy consumes roughly 100 million barrels of oil every single day. Think of this market as one giant flowing chemistry set. The extraction, transit, and refining infrastructure is built for continuous operation. The system physically cannot just hit pause. When 13 million barrels of that daily flow suddenly vanish, the system has to instantly compensate to keep airplanes flying, cargo ships moving, and the global economy functioning. It compensates by pulling from visible reserves, like the ones seen here. These OECD commercial stocks typically hold roughly 3 billion barrels of oil. To make up the deficit, the market is currently drawing down millions of barrels from these specific tanks every single day. Because those tanks are providing the missing volume, the disruption doesn't immediately show up at the gas pump. This buffer effectively masks the severity of the supply shock from anyone looking only at the daily flow. Using finite physical storage to replace baseline daily production creates a structural deadline. Every barrel pulled from the buffer brings the global system one step closer to total exhaustion. The financial news focuses on the flat price of oil. But the physical physics of the market are dictated by the term structure, the shape of the futures curve. This chart plots the price of oil over time. When the market has too much oil, we see an upward sloping line, called contango, where future contracts cost more than immediate delivery. Contango pays traders to buy cheap oil today, store it, and sell it later. Once the excess is stored, the market naturally balances out into a perfectly flat line. But when supply collapses, that curve violently inverts into a state called backwardation. Now, the immediate spot price spikes dramatically higher than future contracts. Right now, Brent crude prompt spreads are trading at historic premiums. Delivering a barrel today costs $6 to $7 more than delivering that exact same barrel next month. Backwardation creates a massive financial penalty for holding on to inventory. It explicitly forces traders to empty their storage tanks immediately to capture that spot premium.
A common error is assuming this downward curve means the market predicts cheaper oil in the future. It doesn't. It means the market is placing an absolute desperate premium on ASAP barrels. Historic backwardation acts as the market's ultimate emergency siren. It definitively proves that the physical deficit is acute, regardless of the calm projected by equity markets. If the physical deficit is so historic, why does the flat price of oil frequently drop by $15 in a single afternoon? The answer lies in behavioral trading. Financial markets price assets based heavily on geopolitical headlines rather than hard volumetric data. Futures traders operate on extremely short time horizons, optimizing for the next few hours or days. Holding a prompt contract at $115 a barrel through a volatile news cycle carries immense downside risk if a sudden geopolitical shift occurs. A mere rumor of ceasefire negotiations can trigger massive, instantaneous algorithmic sell-offs. This creates an opening for political jawboning. Politicians use public statements to verbally intervene, artificially suppressing prices by assuring the market a resolution is imminent. But this intervention creates a paradox. When the market sells off assuming a deal is done, the economic pressure on those politicians evaporates, which actually stalls the negotiations. Because both geopolitical sides look at the subdued prices and believe they are winning the standoff, neither is incentivized to make the real concessions necessary to reopen the strait. This traps the financial market in a chaotic loop of rumors and sell-offs. Meanwhile, the physical data tells a completely different story. This chart tracks that volatility. The top line is the flat price, reacting sharply to the daily news cycle. But underneath it, we plot the physical data. While the price fluctuates wildly, the actual storage levels only move in one direction, down. Look at the exact moments when political rumors cause the financial price to plunge. The physical reserves ignore the headline entirely and continue their steady drain. No amount of political jawboning or algorithmic selling has added a single physical barrel of oil back into the global flow. By trading entirely on political vibes and ignoring the inventory data, the financial system is willfully blinding itself to the structural wall the physical economy is accelerating toward. At the current daily draw rate, the OECD buffer will reach critically low operational limits within months. Once those tanks are empty, the 13 million barrel per day deficit will suddenly hit the open market unmasked. When supply cannot be increased and buffers are depleted, the market is forced to use its only remaining balancing mechanism, demand destruction. To destroy demand, prices must rise. But energy consumption in wealthy Western economies is highly price inelastic. Consumers in North America and Europe have a high propensity to spend. If gasoline goes up $1, they absorb the cost rather than meaningfully reduce their daily driving. Because minor price hikes fail to curb this demand, the price of a barrel must spike violently to find a true breaking point. The market requires income-elastic demand destruction. Prices must rise so aggressively that they trigger widespread job losses and macroeconomic contraction, forcibly removing the consumer's ability to buy fuel. This mechanism carries a harsh distributional impact. It crushes Western disposable income, but it entirely prices out the developing global South, starving them of the energy market completely. The current disconnect between soaring stock prices and a collapsing energy spigot absolutely cannot last once the physical buffers disappear. Physical market mechanics will eventually and inevitably force a $200 barrel, realigning financial expectations with the unyielding reality of supply.